Hey guys, I'm Erica Parker, your queen of real estate, and I am always getting the question, how does a person become a millionaire through real estate? And today I'm going to answer that with the 4 wealth generators and introducing y'all to those and showing you some really cool math. I know it's a little nerdy, but some really cool math so that you can understand how you're getting that return on your investment and why it is such a great avenue and a great vehicle for generating wealth. The first 2 wealth generators you may have heard of. There are 2 different strategies for investing in rental properties. The first is cash flow. So we're going to put that here, cash flow. And that is generally what you're getting on a monthly basis out of the rent income. So that's the profit that you're getting after expenses and the mortgage is paid, basically. And so that is what you're going to get through cash flow. Some people want that passive income coming in throughout the year, and so they want to invest in properties that have a higher cash flow. Now, the second strategy people invest for is for appreciation. And appreciation is where you're going to see quite a bit of wealth build up as well. So appreciation, on average for Texas before the pandemic and before interest rates hit rock bottom to where inflation and appreciation went skyrocketing, the average appreciation for Texas was around 3%. Now, in general, prices, this is the concept that prices will continue to increase over time and your home's value will continue to increase over time. So, you're going to have those times where the market may collapse like in 2008 or something, but it usually, over the grand scheme of things, does recover and then continues to increase. So you may have it go like this, but it's always going to be cyclical in an upwards trajectory. Now, some people may look at certain areas that have higher appreciation and may invest in ones that show 6% appreciation. Now, these particular areas do tend to cost more to get into, and they do tend to have less of a cash flow. So there are give and takes for cash flow versus appreciation. Appreciation is trying to build long-term wealth. Cash flow is really for that passive income, that income that you need now. Now, the third wealth generator that you will be getting is the pay down of the loan. A lot of people forget about this one. And that's what's so great is that you actually have that rent payment that people are paying you to live in the house. That's going towards your mortgage and paying down that mortgage. So while the house is also appreciating, the house is also getting its mortgage paid down. Now, for that first part, it's going to have kind of a slower increase, but as you get more of it paid off, more of that money is going towards your principal being paid off rather than the interest. So that is going to be the next way that you're generating wealth. Now, the fourth one, and we're not going to talk about it that much here, but the fourth one is tax benefits. And with that, there's a couple of tax benefits that I can at least introduce you to here. The first one is that rental income is actually taxed at a way lower bracket than other types of income. So if you work and you make $100,000 and you rent houses and make $100,000, you're going to pay significantly less in taxes on the rental property income than you will on the working income. So that's one thing to consider. Another thing, if you do own these in LLCs, you can depreciate the asset over a 20-year span. So you can write off that value of that asset over the next 27 years. But it is very important that if you are looking to invest in real estate in a larger scale, that you probably do create LLCs and you get a really awesome CPA that knows how to really delve into the tax benefits of real estate and how to write off certain things and that particular realm. So here's where the geeky numbers side of me comes out. I was awesome at math, but it's important that if you're a real estate investor that you do know this math, because this is how you decide if you want to invest in a property or not. You buy a house. That's right, I was not an art major. You buy a house for $200,000. Now I know a lot of people like to say $100,000 because it's easy math, but let's get real. Appreciation has been insane the last couple of years. So we're gonna start at $200,000 just to be on the safe side. So you buy a house for $200,000. Now we're gonna say that you put $40,000 down. That is your initial investment. And you get a loan for $160,000. Now let me tell you right now, this is a conventional type of loan for rental properties. This is not the only way that you can get a rental property. There are actually a lot of different ways that you can put less money down and even possibly no money down to get properties. And we'll go into that in other videos. But for now, we're gonna just show you the conventional investment to see what kind of return on your investment you're getting here versus the stock market or elsewhere. Now say after all expenses are paid on this $200,000 house, after you've paid the mortgage and maybe you agreed to pay the water or the trash or something along those lines, then all expenses paid, let's say you're making $200 a month. Now that's not that much, but it may cover some kind of bill that you've got going, some electric bill, something like that. But over 12 months, that is $2,400 a year. So that's not too bad, but it may not be the thing that drives or floats your boat. So you have appreciation. And in appreciation, like I said, in Texas, the average appreciation prior to interest rates sinking and appreciation going crazy, we had an average of 3%. So for that same year, 3% of 200K is $6,000. And then finally, you're paying down that loan. So the loan pay down. And you're starting out with that loan being 160K. And a year in, which is probably right here, you're probably at 158K. And that's about $2,000 has been paid down. Now this is based on a 6% loan. 6% interest loan. That's a little high for what people are seeing in interest rates right now, but that is also very common for an interest rate for a rental property to be more than the interest rate for a homesteaded property. So we're gonna say 6% is what we got this $160,000 loan for. So that's $2,000 that you've paid down on the loan. We've talked about this briefly, but as the appreciation goes up and the loan gets paid down, that amount in between here, so you bought it for $40,000, it was $40,000 right here, you bought it at 200K and you got the loan at 160K. So as you get this paid off, this amount in between is called your equity. Now, if you look at these numbers and you add them up, this equals $10,400 per year, or that first year, we should say, because it does increase year over year because of this little number right here. So you made $10,400 in return on your investment of $40,000. That is an over 25% return on your investment in the first year, guys. So that is why this is so important to understand. So let's delve into, I know you're saying, okay, $10,000, great. Like, how do people become millionaires? So let me show you what it looks like in 10 years. The cash flow over a 10-year period, say you don't necessarily increase in the cash flow, but we do know rents tend to go up and so do property taxes. So we'll say that your actual spread stays at about $200. So at $200 in cash flow, that means over 10 years, you've earned $24,000. And if you want to look at the math, that's $2,400 a year times 10 is $24,000. So the next thing is you've got that appreciation. So this is 1. 2 is that appreciation per month or per year that's going up at 3%. So every year it's $6,000. So 10 years, you've earned $60,000. Your house that was $200,000 after 10 years should be worth somewhere around $260,000. So after 2 years, you've earned $60,000 on the appreciation. So let's draw that 200. And you're 10 years down the road, it's $260,000. That's what it's worth. And about 10 years in, you're at $134K. So over 10 years, you've paid $26,000 down. Now that added up is $110,000. Now here's the cool part. At $110,000, you take that and you divide it by 10 years. So you're making $11,000 per year on average. And you put $40,000 in originally. That is 27.5% average rate of return on your investment. So you're making 27.5, whereas you may not be making near that much if you would put $40,000 into the actual market, stock market or something like that. And I know a lot of people sit there and ask, like, how do I get access to, but a lot of this is equity that is sitting in this property that I don't have access to. There are ways to get access to it, and you don't necessarily need to sell the property in order to get access to it, whereas in the stock market, you have to sell your stock to get access to that. You may be asking, well, that's $110,000. How do you become a millionaire? Well, you have 10 properties of these, then you're a millionaire over 10 years, after 10 years. But you do have a lot of people that will do what they'll do is, so your initial investment was $40,000. You've made $110,000. They may go and sell this property. So right now you've got a equity split basically of you've got 60,000, you've got 26,000, you've got 40,000. So all of that together is about 126,000. So they'll go and sell this property and they'll get their $126,000 out, and then they'll take $40,000 and invest. They'll invest that 3 times basically, because 126,000 divided by 40,000, about three different properties. They'll buy 3 more properties at 200,000 and do this all over again. But again, this isn't the only property they invested in. They may be investing in other properties that they only put 5% down, or that they were able to get at a discounted, distressed rate, or they were able to get subject to. So there are a lot of ways that you can buy a property without putting near as much money down, but the overall concept is accurate as you get into a higher bracket of the appreciation side, especially if you get into like 6% appreciation in an area or something along those lines, and you can really start seeing those numbers increase. And so some people may, like I said, invest in for the passive income, but if you're making, say, $1,000 a month and in the cash flow, there still is, on most of the times, there's going to be some maintenance. So we want to take that into account eventually in our numbers. But this is the overall item that I wanted to highlight for you. I hope you found this information helpful. If so, please give it a big thumbs up. I think this real estate math should be shown to everyone, because this is how you become wealthy, and this is how you create your legacy in the real estate realm, and a legacy for your family as well. So I hope you guys have a great day, and we'll talk soon. Bye for now.